Structured notes. How do they work? What are they? Should you have them in your retirement investment plan? These are all the questions that we answer in this episode to make sure that you know exactly what you're doing when it comes to your retirement plan, your investment plan, so that you can have a safe, secure retirement and peace of mind all throughout your retirement.
To learn more about how to secure your retirement and all the different elements you need to know, please subscribe to our channel and hit the bell so you'll be notified when we release episodes every Monday. We have helped hundreds of our clients gain clarity and get on the path to a great retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to our Secure Your Retirement podcast. And here we sit on the last Monday of November. It's unbelievable. This is our wind down, but it's going to be power packed. So Morgan, can you tell us a little bit about what we're going to talk about today?
We are talking about structured notes today and the frequently asked questions around them. To start it off, we're going to just cover what they are, how they're issued, who they're issued by, how do they work, what are the risks around them, can you sell them, when would the notes get called, and what are the costs to buy them. But before we get started on that, wanted to talk a little bit about the wine that we're drinking.
Oh, yeah. Okay.
It
Well,
is
if
a
you think
wind
that's
down.
important.
Skip the whole wine down part, Brady.
To jump right into business.
Today, we are drinking a Cabernet Sauvignon from Joel Gott Winery in California. It's in the Napa Valley, and it's kind of a fruity forward Cabernet, if I would say.
Yeah, I think it's pretty good. But I mean, wine is wine. When we don't want to talk about wine, let's talk about these things called structured notes. That's super exciting.
It is super exciting. So what are they, right? And what are structured notes?
Well, let me just say this on our discussion today is that we are going to keep this somewhat high level. And some of these things, as we explain them, would be a little bit better or easier if we were doing it visually. But we're going to try to describe things in a way to help you visualize them. And I will say that to think about what they are, think about the title. They are a structured note. And that means that a bank is going to structure the note so that it will perform really for one of two categories: risk managed growth or income. The ones that Merce and I are using right now are all income based. So just to kind of understand how they work, a bank will basically look at a couple of different elements. They're going to look at interest rates, they're going to look at volatility in the stock market, and they're going to look at some indexes, which we'll go into a little bit later. And based on those elements, they're going to come out and say, hey, we think that we could pay a certain amount of a coupon rate or interest rate over a period of time. The beauty of these is that we are able to kind of build them to fit whatever we want. So if we say I want to be guaranteed for the next 6 months, well, then I'm going to make less money than if I say I want it being guaranteed for the next 3. So we'll go into that in a little bit more detail. Big picture here is they're going to be structured to either give us risk managed growth or income. And the ones that we talk about the most are income structured.
So who are they issued by?
So they are, Rayton already said it, they're issued by banks like your JP Morgan or your Morgan Stanley or any other major bank out there. They all have the ability to issue them. And just like when you're picking a bank or you're picking an advisor or you're picking an insurance company that you want to work with, you want to evaluate the risk that's going to come with that bank because they are the one that's backing the note and it's not the government. Not a bank can't just keep printing money like the government can. So there is some underlying risk to the bank that you choose. So all the banks that we're looking at are very highly credit rated and have a lot of deposits on them. But ultimately, what we do is when we're going to purchase a note, we are going and shopping banks. We're going to the banks and saying, hey, here are my stipulations, those structures that Rayton was talking about. Here's the different things that I want. And here's how much money we're going to put into this note. And what can you offer us? And so the bank is going to come back to us with an offering based off of our criteria. But ultimately, it's the bank who's issuing them.
So once you pick one, how do they work?
Okay, so now I'm going to need you to put on some of that mind's eye that you can see and visualize things. And I'm going to, again, not talk about a specific structured note because we could do so many things with them, but I'm just going to use general terms and general explanation. So what happens is, and I'm going to talk about now, again, we could go 100 different ways on how they could be structured. I'm just going to use one of the structures because we don't want to get bogged down into a ton of details. But here's the way they work. We're going to start with an underlying stock or index. We personally like to look at indexes, and we want to look at large indexes that are not super volatile. And typically, in order to dial the risk down even further, we're going to use at least 3 indexes as our underlier. Now, let me explain kind of how that works. Big picture, what's going to happen is all 3 of my indexes, when I buy them, are going to have a beginning start date. Once that occurs, I am now going to have a few different things that could occur. If my indexes, all 3 of my indexes are negative or flat, then I am going to get a coupon payment. And let's just, for this purpose, say that the coupon payment is 12%. That means every month I'm going to get a 1% coupon payment on that buy. Now, there's a couple of variables here, and that is what we have, or which are called some barriers. And I'll explain that a little bit more later. So these barriers work this way. If any one of those indexes are down by the barrier amount, so let's just say it's 30%. So I buy this in, let's just use the S&P 500 as one of my indexes. Let's say that that index is, one of the indexes is down 30% or more from the date I buy it. I'm not going to get a coupon payment that month. I didn't lose any money. I just didn't get my coupon payment. So that's one aspect of the product. The second one is my principal barrier. And my principal barrier says if any one of those indexes are down 40% or more, in this example, they can vary, then I would then, on the date of the renewal of the contract, I could be down by that 40% or more. So here's the key of the way we build them. We want to build them so that the risk of that occurring is less than 10%. And the amount of time that we hold it could be anywhere from 6 months to 2-3 years. We try to keep them on the shorter term. So again, we're going to have a coupon payment based on the month. We're going to have a principal barrier based on the time of the actual structured product. High level, we can go back and talk about that further.
You mentioned barriers a couple times. What do you mean when you say barrier?
All right, Merce, can you go in that a little bit more and explain the barrier?
Yeah, so look at the barrier as a line kind of drawn in the sand that if we go below this point, then we're not going to get one of 2 things. We're not going to get the coupon payment. So in the example of it being a 12% coupon annualized, that means you'll get 1% of that every single month. But if the coupon barrier has been breached, you've gone past that line in the sand on the date of what they say date of valuation. So say you bought the note on January 1, and we get to a month, they're looking at it on the 1st of every month. And if we're looking at it on, say, March or April 1st, and the index has breached past the coupon barrier, that means you're not going to get that coupon just for that month. Now, the index, as we know, volatility, as we see the markets move every day, the indexes can go back above that barrier. And the next month, April or May of the next month, the first day, as long as we were back above that coupon barrier, we're going to get that coupon for that month. So that's one of them. The other barrier is going to be your principal protection. So these notes are providing coupon interest payments. They're also providing a level of protection from losing principal. Not guaranteed that you're going to not lose principal, but there is a high level that you're going to get your principal back. So I was talking monthly on the coupons. On the barrier, it's very important to understand on the principal barrier, the only way that you can lose money in this structured note is at the end of the term, not on the month, but on the end of the term. So let's say we bought it January 1 of 2022, and we are now at January 1 of 2023, and it's a 12-month term. So we've been in it for 1 year. Doesn't matter what the indexes do in between that 1-year window. All that matters is on January 1 of 2023, where are we at from a principal protection barrier? Have we pierced below that number? So in Radin's case, it was a 40% protection. As long as the worst of the indexes has not fallen more than 40%, you get your principal back. So maybe you paid $1,000 to get this note. We're going to see that happen 90% of the time. There's a 10% chance where we could be down past the barrier of the protection. So say we're down 41%. Well, that means that one note will lose some of its principal. It's going to lose about 41% because now the barrier has been broken. We're at the date of recognition and it's below. So we could lose our principal there, but also realize that for a lot of this, you probably got some coupon payments. So you could say, well, man, I'm down 40% in this note, but you actually got coupon payments all along. So you're not down a true 40%. And we can get into, how do we structure these and what's the strategy? But ultimately what we're doing is we're buying small chunks. And so that we are laddering and being very careful about how much we put into each of these notes. So we're diversifying even the risk of a barrier being breached.
So what are the risks associated with the structured
Ah.
notes?
We talked about a couple of those, but what I was going to say is that there's actually a couple different things that we have to keep in mind. Number one is the bank, the issuing bank. And then the second one is the barriers that we talked about. So we could actually build a structured product that was at high risk. We could use a very high risk underlier, and we could try to say that we'd only want a barrier that's 10% instead of 40%. And the more we do that, the higher our coupon rate's going to be, but the higher the risk is going to be. So what Merce and I are trying to do is when we buy these, we are trying to structure them so that the risk is less than a 10% chance on the principal barrier being breached. And that is back testing it for a long, long time. Now, the other one is the bank. So we only want to use very high quality banks to make sure that we're not going to run into any kind of an issue there. So you take a JP Morgan, for example. Could there be problems? There could be. But that kind of leads us to a question of, can I sell them? And we'll get to that in just a couple minutes.
Well, that actually was
Oh,
my
that
next
was your next question.
Yeah.
So can you sell them? The answer is yes. Realize that there are some intricacies as to how it works. Do you sell them? Do you get your money back? Do you lose money? Do you make money? Ultimately, the way that these notes are structured, the bank in the background is doing some background investing in the options market and derivatives market. So if they are, it's all going to depend on timing as to when you want to sell. If you buy it today and you want to sell it tomorrow, very likely you're going to lose money on it because you're committing to a term with the bank, and the bank has now created an investment around this term, and they're buying agreements or options to these different indexes for a period of time. If you exit, or if you tell the bank, I want to exit early, well, they will do that. But what they're going to have to do is shop for an exiting. They're going to pay a penalty, and ultimately they're going to transition that penalty down to you. Now, there is a possibility where the options could be what they call in the money, which means they are positive and you could actually make money on the sale. But ultimately, the moral of the story here is that you really don't want to be buying these if you're not going to be ready to hold it to whatever term that you're buying. So we're buying shorter term ones right now, anywhere between 12 to 18 months, and we're not putting a ton of money into them either. So we're keeping plenty of liquidity on the side so that very rarely would someone have to completely exit any of these positions.
So when would the notes get called?
So let's just talk about what that means first, getting called. Okay. So the notes that we are buying. So Merce talks about these terms, a 12-month term or an 18-month term. The likelihood that we will hold it for that whole term is highly unlikely. Why? Because likely these notes are going to get called, and they work off of what we call an auto call. When that call means that the bank could actually call the note back, right? They could bring it back in and void out the note. So the way we're buying them right now is we say we want 3 months that the bank cannot call it. So we buy it for 3 months. We're going to get our coupon. After the 3 months, if the least performing index is either positive or flat, that means 2 of them are positive. The worst one is either flat or a little bit positive. This note will automatically get called. And that means that we now are going to have to go out and buy another one. So you think about it, we're buying notes right now with the market down. The likelihood is the market comes back up. It doesn't have to go very far at all to say that it's a little bit positive or flat. And so they're going to get automatically called. So it is a lot of work on our part to have to keep these things rotating, but we are way more likely that they're going to get called early than we're going to hold them for the duration of the term.
And to add to that, just like on the coupon, when you get your coupon, it's based off of where the indexes are on the date evaluation on the, say, January 1st, like I was doing in that example. Same thing with the call. The call can only happen on the date evaluation. So that's what they're looking at. And then there was one other thing that I had in my mind that I wanted to clarify, but if it comes back to me, Morgan, I'll jump it back in.
Well, I was wondering, what are the costs to buy them?
So it's an interesting story. The cost used to be pretty expensive to buy these if you go back 20, 30, 40 years ago. And the structured note world was really, really designed for the ultra rich and the hedge fund world and everything like that. Now with efficiencies that have come across trading platforms and everything like that, and the ability for banks to start doing what they're doing, the costs have come down significantly. And to where it is now more available to your average investor. But the only way, I told a client this today, actually, that she was asking questions about the notes, and I told her you could not go to JP Morgan yourself really and just buy these with a couple $1,000s. It takes a few $1 million to structure these deals. And so the advantage that she has working with us is that we're working with a large group of people and millions of dollars. And so when we go to banks, they want our business, and they're going to try to structure those in our favor, because we're not giving them a couple $1,000s. We're giving them a few $1 million in each different buy. And so they want that money, which is going to give us a little bit of an advantage. But the cost has gone down tremendously, and the availability has gone up very much if you're working with the right group. We see it as a really good tool, especially in times of volatility, especially when there's so much uncertainty in the markets. These do have a decent level of predictability as far as what you're going to get out of them and also what the risk is.
Yeah, and I just want to say that we know that trying to describe something like this on a show, a podcast that is pretty much you listening to us talk could be difficult. So there's a couple of things that I'm going to tell you that you can do to help you get this maybe a little bit better understanding. One is we do have a blog that is written on this very topic. You can go to our website, which is pomwealth.net/blog. And then if that's not going to be good enough, which we don't think it will be. So in the next little bit, our plan is the first of the year is that we're going to do a webinar on this particular topic, and we'll be able to have visuals at that point to walk you through exactly how they look. And so we'll be coming out with information on that. Make sure you keep an eye out on our website, on our events page, and we'll have that listed with all the information that you would need to be able to be a part of that webinar. But thank you very much. We hope we have not confused you to the largest degree, but at least given you some insight. I'll close with this. The structured notes give us a nice income stream and can be structured to have very, very low risk, not correlated to the stock market. And that's probably the biggest part of the story. So keep that in mind. But thank you very much. We hope you've enjoyed the wind down. We'll talk to you again next Monday.
We hope this video has given you some confidence and clarity as you plan for a worry-free life in retirement. But what else do you need? We have created a complimentary video course called 3 Keys to Secure Your Retirement. This video walks you through step by step what you need to do to get ready for retirement. You can also check out our podcast called Secure Your Retirement. You can subscribe below.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.